Hello and welcome to today's episode of Capital in Context. We are on episode 7, already started to rack these numbers up. For full disclosure today, this episode is meant for professional audiences only and not for retail investors. Any information that you hear today is for informational purposes and is not meant as part of a financial promotion. For full disclosure, we do or are about to hold a holding within Mike's Alquity India Fund. We have been in this, we have exited, we've gone back in. This is not actually due to Mike's inclusion within this episode, and any performance figures you hear are for past performance and not necessarily indicative of future performance. So without further ado, I'd like to introduce you to this first fund manager interview episode, where we have with us today Mike Sell, who is manager of actually, why don't I let you introduce yourself, Mike?
Thanks, Sam. I'm Mike Sell. I'm the head of emerging markets at Alquity, and I'm the manager of the Alquity India Fund.
Thanks, Mike. So obviously, India didn't have a great 2025. In dollar terms was up 6.8%, an EM average of, in dollar terms, 42.8% was a fantastic year. Obviously, India had a great 24 and 23. For a market that you widely regard as a structural growth story in EM, that's quite a bit of underperformance. What was behind that?
I think there are a number of factors behind that. Firstly, there was a bit of a growth scare about 18 months ago, and India really is a growth story. So if you're not getting the growth coming through, then that's really going to scare the horses, so to speak. At the time, we highlighted that was due to a number of one-off factors, and the underlying growth story was actually very robust. But nevertheless, that, I think, was the catalyst for the period of underperformance. That then was combined with two other things, both of which were transitory. Firstly, Trump, which obviously is impacting markets globally. But India has not been in Trump's good graces and has suffered earlier some very high penal tariff rates. And whilst that doesn't matter for the Indian story, which is virtually entirely domestically driven, it upset sentiment. And then thirdly, there's been newer, brighter, shinier things out there, sort of Korea, AI, you alluded to it in terms of the overall performance of emerging markets. And I think India just wasn't the new shiny thing. And so I think those three things combined led to that period of underperformance.
Cool. So also looking at 2025, so foreign outflows were very high indeed, but domestic inflows were very positive. What's necessarily behind the divergence in those two elements?
Yeah, it's really fascinating. It's been a polar opposite. It was one of the best years ever for domestic inflows into the market, which has been building year after year, all the way from before, after COVID, and has continued. And foreigners have done the exact opposite. Now, I think foreigners took money out for the reasons we just talked about. There were other areas they wanted to go into instead. And we would very much argue that India is a long-term structural part of people's portfolios, given its really low correlation with the markets. But I think some people treat it as a tactical position. So I think that's the first thing. Domestic investors see the Indian growth story, the domestic Indian growth story, every day they walk outside their front door. And I think they very much have had the confidence to keep on putting money into the market. And I guess the question is, who's right? Is it the foreigners or is it the local investors? I would say, having invested in India for 30 years, it's very clearly the local investors.
Okay. And active fund allocations to India are really quite low at the moment. Why do you think confidence in that space is looking pretty low? Do you actually see it as do you see it as a contrarian opportunity? Obviously, you're going to have a little bit of bias in this. Or do you see it as kind of like there is a genuine, more full-on investment case? Obviously, you also manage a wider EM fund as well. So where's the balance in that there?
It won't surprise you that I think it's a great opportunity. Allocations to emerging market, to India from global investors are at a 30-year low. That's basically my entire career. And the dichotomy between that and the underlying story on the ground is completely vast. Now, I'm the manager of an Indian fund. Of course, you'd expect me to say that. But I'm also the manager of the Global Emerging Markets Fund. And for us in that context, India, without doubt, is our most favourite market for 2026, given the superlative underlying story, which I'm sure we'll come on to, but the fact it's been sold off unfairly by investors. And we think that dichotomy certainly won't persist for any meaningful length of time.
I find it quite an interesting one. So, like, obviously, my job as an asset allocator within a multi-asset space is the reward is to come from noticing those changes very much, when the flows start changing on a wider asset basis. And I think that's, from my perspective, obviously we've been talking back again. Obviously we've been in conversation now for a very long time, but it's
you make me sound old.
Making me sound a bit older now. But for say about a year, but it does seem recently that the opportunities are becoming a little bit more apparent. But as the active interest isn't there yet, which is when typically it's a good time for me to buy in if I understand the full investment case. Just to help explain that to the wider audience. So that's a good intro. This area is a little bit more interesting considering, so for context, we're recording today on Tuesday, the 9th of March. The Iran conflict has been going on now for, I think today's day 10. And last night we had Trump saying that the war is nearly virtually over. Transits through the Strait of Hormuz are going to start soon, which I find quite interesting because there's a bit of a difference there between when it's strictly open versus when insurance on vessels gets reinstated and flows continue. So we've still got at least another 2 or so weeks before any flows really start going on. So let's put this into context of a macro picture, but already existed. So inflation was already under control with rates coming down. Credit growth was accelerating, which is great for the story within the economy. And Q4 earnings were the strongest in 2 years. How do you figure that structural improving backdrop versus, say, the headwinds when it comes to higher oil prices and all of that kind of element?
Oil has always been one of India's potential Achilles heels throughout my career. It's much less of an issue than it was 10, 20, 30 years ago due to the rise in renewables, solar, wind, etc. And when I meet companies in India, virtually every company talks about their increasing usage of renewables. You didn't have that conversation 5 years ago, let alone 10 or 15. But it still matters. India imports a huge amount of its energy requirement, both oil and gas. Now, for every $10 increase in the price of a barrel of oil, that adds around 50 basis points to the current account deficit. Okay. So a $40 increase, let's say, still gets you a current account deficit of around 3%, just below. Not great, but absolutely not in danger territory. Last inflation print was 2 and change, between 2 and 3%. Again, $10 on the barrel of oil adds about 50 basis points to inflation. So again, you're going to be up a bit, but you're going to be slightly above the RBI range, but not massively. Okay. So again, what's been going on in the Gulf recently, which, as we talk today, seems to be subsiding, and certainly we see as transitory, as has been the case previously, it could result in a very temporary issue, but it'll be a very minor issue in terms of India's overall health. Now, when I started my career, India was almost a frontier market. We didn't call it that, but it was an emerging market. Now it's certainly one of the most stable emerging markets. It is not like Indonesia, Brazil, South Africa. Their foreign exchange reserves are well over $700 billion. So it absolutely can withstand a temporary blip. And what I've said throughout in the last few months and quarters is oil between 60 and 80, absolutely fine for India. The lower the better, but 60 to 80 is a good range. If we spike to 120 for a couple of months, doesn't really matter. That's fine. If we have 120, 130 for an extended period of time, 6 months, a year, then that certainly would be something that would be a risk. But as you rightly said, things have calmed down. And it doesn't seem, given what's gone on in the last few years with numerous wars in the Middle East, the Ukraine conflict, oil has never spiked to these high levels for any serious amount of time. And I don't believe, given the news, that will be the case today. And so this is another blip on the road for India. History shows how well India has managed with them over time. And I think from my side, it's a particularly interesting time to therefore look at India right now.
I think that hits actually quite, again, an interesting point. You brushed around it on for what is part of my role, which is we can't be looking all the time at the short-term picture. One thing that a lot of asset allocators can be quite guilty of is overtrading. And very much looking at that short-term picture. Don't get me wrong; it matters very much for your initial buy point or your initial sell point, but not when you're looking at. You need to be looking at these things over a longer picture. And as you said, one point yesterday we were looking at Brent at 120. As we speak right now, it's gone just back over again, but say 90. We're also looking at the futures curve again, heading back down to round about within 12 months, back around about 70 USD. All these things, very much feed into what you're saying. I'm trying to be a little bit more adversarial with this, but unfortunately, I'm struggling a little bit. But certainly trying to be balanced. So, despite the fact that obviously dollar was weak 2025, rupee fell further. Is that structural or noise or what's going on there? That came as a bit of a surprise versus the wider EM landscape.
Yeah, I mean, the rupee is sensitive to a few things. I mean, obviously, oil is one. Gold is another. Gold is less of people's natural wealth, personal wealth, than it was before, but it's still a very big part culturally. Obviously, the higher gold price has fed through to that. India is a domestically driven story. They do export, and their share of global exports is increasing. And as I said, foreign exchange reserves are 700 billion plus. So it absolutely isn't a structural problem. We did a lot of analysis on this a few months back, and in our view, again, it comes back to this sentiment point. With the concerns about the tariffs that Trump put on India, and then the extra tariffs because they were buying Russian oil, I think that is what led to the weakness in the rupee versus the dollar. And obviously the dollar was weak versus sterling on top of that as well. So we don't expect that to persist over the medium term. A little bit of rupee weakness versus the dollar is what you've seen in the past. And we don't expect it to persist in any meaningful way.
What do you think? Sorry if you just answered this. What do you think would perhaps be the drivers to reverse that to a degree? Obviously, we've had in the very near term, we've had a little bit of safe haven going on, but so just to be clear on terms of sensitivity to gold, is that gold up, rupee down? I assume
at the margin, yes.
Yeah,
but I mean, oil's the big one.
Yeah.
Gold a little bit, so that hasn't helped, but that isn't the key driver. Look, I think. As we sit here today, we actually saw the reversal of the rupee. That's been masked again by the events in the Gulf, which, as we talked about, are transitory. But when India signed the free trade deal with the European Union, which is very meaningful, and then when they came to agreement with with Trump on tariffs, then again, that's when the sentiment seemed to shift, and you started seeing foreigners reinvest in the markets. Foreign inflows picked up. We had a couple of billion go in, and then also you saw the rupee strengthen versus its previous weak levels. That was, in our view, the turning point in sentiment, and the turning point in the rupee. That then obviously has walked into the latest crisis in the Gulf. As that passes, then the evidence of that turning point that we've already seen in markets will then flip back in the coming days and weeks, in our view.
So, obviously, one of the things that go back to March last year, I think it was March last year, we am I right thinking that was before we had the pullback? Just about, it was about April, March.
We were in it. We were in it. Yeah.
So leading just before that, you kn- India was doing excellently, but it started to get a little bit pricey. Don't get me wrong, India has always had a little bit of a premium going on. A, what is the driver behind that? And B, what do you feel is the justification behind that?
You're right. My number one question I always get asked is about the rupee. My number two question is always about valuations, and I think it's really, really important to delve into this. When you look at traditional price to earnings metrics, you're looking at 1 year, 2 year forward. India is unlike any other large growth opportunity in the world where you don't have 1 or 2 years of growth. You have 5, 10, maybe 20 years of structural growth driven by its demographics, urbanization, the shift from the informal to the formal economy. So when you're looking at a PE 1 or 2 years out, you're going to see a big number, but that doesn't really factor in the next 5, 10 years you've got as well. And as you said in the intro, India has given you very, very strong returns over the last 5 and 10 years. If we'd had that conversation then, we'd have had the same conversation about valuations. As long as you have that growth persisting for that duration of time, then the valuations are absolutely justified. And that's why, going back to what we said before, when you had a concern that was false about growth, you saw that sell-off. The other point to mention is India has one of the highest return on equities of virtually any market. It's not America's better, but most other markets are not as good as India, whether that's emerging or developed. And so again, that again justifies the premium. It's worth noting as we sit here today, though, that the premium of India versus emerging has shrunk dramatically. And indeed, India versus its history is also looking attractive, which again is perhaps well-timed conversation.
I think this is something actually we've discussed in the past, which is what you tend to find is that India does have this valuation multiple expansion, the growth, and then it kind of pulls back, and that premium versus the wider EM market shrinks, and then it starts to pick up again. Do you feel we're close to that reoccurring, or what drivers do there need to be for that to pick up again?
Short answer to that is yes, I do think we're at that inflection point. I think that inflection point was when Trump reduced the tariffs on India. That's been masked by what's been going on in the Gulf. But yes, I do think we're there. If you look at what drove emerging markets last year, Korea was up very, very strongly, 90% last year in dollar terms. Is it going up another 90%? No, I don't think so. AI has done incredibly well. Do we think AI is going to hit a bust? No. But will you see another year of such super normal returns? No. So I think you're going to see people recognize that structural story in India that they've known with much cheaper valuations. And as they take profits and rotate for some of these very hot areas last year, that money will naturally find its home into India. And 90% of the conversations I have about emerging markets these days are with investors who have either been in India before or have been looking or have some, and all are thinking about is now the time to maybe add some more or to initiate a position.
Thank you. So we've covered quite a lot about India in general. Let's go a little bit more in terms of like your experience literally in your day-to-day working life. So you've just come back from research trip covering, I've got here, Delhi, Mumbai, Bangalore and Kanpur. I imagine there's a few others perhaps thrown in the mix as well, with around 40 company meetings. What's kind of the mood there, or how does it, if it's positive, how does it perhaps differ from other times that it's been positive? What's kind of like the more current vibe going on there?
So I think it was a really well-timed trip. Firstly, because I got back before the problems in the Gulf started, but also really wanted to road test our thesis that you look at the great macro data, the accelerating GDP, the accelerating earnings, etc. But let's go down to the granular corporate level, and is what companies are seeing on the ground and what they're talking about matching what we're seeing fundamentally, or does it match what the market's been telling us, which is there's been a little bit of a problem. And obviously I'm very pleased that it matches very much the positive view on India. And so seeing companies both in their offices, at conferences, on the ground, gives us a really broad feel. Seeing well over 40 companies over that period in a variety of sectors gives you unparalleled first-hand insights into what they are seeing, which has added and reaffirmed our positive view.
I understand that one of the concerns was getting flagged up was AI. Is that in part because a lot of the Indian economy, I've got to throw some presumptions out there, kind of going back 30 plus years, was, it was the offshoring of parts of the services sector, and that's an area that AI seems to be have a use case for quite obviously. What's kind of the vibe in terms of, is AI a beneficiary factor for India, or is it something that's going to have a few challenges along the way from a macro perspective?
I think we need to split it into two parts. India has become very well known for software companies, companies like Infosys, Tata Consultancy. They're well-known names, even in the UK, because they do so much work for the government and so on. And I think the jury is very much out whether AI is a positive or negative for them. Now, we have some exposure in our portfolio, but it's quite small because they're great companies with great returns. But we're certainly underweight where the index weight would be. Now, at the entry level work they do, I think it's very clear that AI will remove some of the coding work that they do. You can do it on AI as quickly, better, cheaper than you can with humans. At the high end, companies very much need to harness AI, and they're not going to let AI agents sort of roam around their internal systems. That's going to need to be worked on by companies that understand that, such as Infosys and TCS. So it's changing what it means for them, and I think there's going to be positives and negatives for them, and it's too early to tell which one wins. I met both companies when I was out there. Obviously, they're very much on the positive camp, as you'd expect, but I think there's some negatives to be taken account on. So that's one part. The second part is the move generally in the Indian economy from a physical to an online economy, the trend of digitalization. And AI there, I think, is generally going to be a positive. It's going to help accelerate that and help create efficiencies. Now, over the last month before the Gulf crisis, there was very much a scare in global markets that AI would kill the business models of many software and digital companies. And there's clearly a risk of that. And I think certainly if you're a digital company that is some sort of comparison site, comparing travel packages, but no added value, no added insurance, no booking potential, I think you have a real problem with AI. For our companies in Digital India, they have their own products. They manufacture something as well as the digital transition. And so speaking to management, doing our own analysis, we spent a lot of time with this over the last month. It's all about moats. Do you have a moat to protect you from the low-end AI encroaching on your business? And our companies do. So I think it's a clear positive there. One other thing I must say is, as part of what I think is our uniqueness, we hold consumer panels with people generally from sort of lower income strata. And most of my fund managers don't do that. And it was really interesting that every single one of these, they're all ladies as it happened, now shops online. When I met them a couple of years ago, that really wasn't the case. And this is not your sort of urban middle class. This is sort of lower income segments of the population in a smaller city. Still 1 million people, that's a small city in India. But now they 100% shop online. And that just really illustrates how India is changing. And I think AI is going to certainly help that.
Does that mean that, say, the e-commerce growth story in India is kind of maturing, or is it still very much a structural perhaps benefit within portfolios for positioning?
I think you need to split the population into a couple of segments. Sort of, let's call it the middle class, for the want of a better phrase, and that's 200 or 300 million people. So that's pretty much almost the size of the EU. And the use of e-commerce and the digital economy there is fairly similar to what we'd see here, if not better, in fact. If you want to order your groceries, you can have them in 10 minutes. I think some of our supermarkets would struggle with with that. In the mass part of the population, so the lower income, now e-commerce is now very widespread, as is other online platforms. And so the availability and the awareness is there. It's now about deepening usage of it. Instead of using it, once a month, you use it once a week, etc. So I think at the higher end, the middle class, I think it's about an economic growth story. It's not a penetration argument. Yeah. In the rest of the economy, which is the most of it, I think we are still in the penetration story, and we're still in the very early foothills.
Sounds positive. Obviously, as you said, it was fortunate that you managed to get back before airspace became a little bit problematic between India and the UK. Travel and leisure is quite a major thing within your portfolio. A, unpacking that opportunity generally, but B, how long does the Gulf crisis need to go on before it starts becoming an issue?
So taking the second bit first, India is such a vast, diverse country. You don't need to go abroad to experience whether you want mountains, whether you want beaches, whether you want temples. It's got it all. It's like America in that sense. And so many Americans don't go abroad because they just vacation in America. You have the same thing there. So I think from that angle, there's no real need. And we mustn't have a Eurocentric version of this. Of course, a lot of middle class and wealthy Indians go to Dubai to vacation, and that's going to be problematic for a period of time. But whilst they're not going to go that way round, they absolutely will go to Thailand or to Australia, and so we mustn't think of it just as Europe and it's hard to get there. They don't need to come this way; they can go the other way to experience that. But the majority of tourism, and certainly where we see the growth, is in domestic tourism. Now, unpacking that in a couple of ways. Firstly, in India, the total number of hotel rooms is less than Las Vegas for the whole country. The number versus China is a fraction, let alone somewhere like the US. So there is massive potential. Now, what causes that potential to become realized? Well, a couple of things. People have more money, they have more leisure time, and that's a trend we see throughout. But with Prime Minister Modi's reforms, they've built the infrastructure. Before, it was really hard to go away for the weekend or for a week because the airports were appalling, the roads were appalling to get to the airports. That's changed, and the number of new airports being built is exponential. And having been going there for 30 years, I can testify with my own eyes that some of them, maybe the UK is not the best example, but put the UK to shame by a country mile. And they're some of the best that you would see in the world. So that's been very much the enabling factor, that the infrastructure is now there so that people can take advantage of these things. The second thing is, how many TVs do you need? I mean, if you have some more money, are you going to buy another TV for your house? You're probably not. You're probably going to go away for the weekend, have an experience. And India is going to start reaching that inflection point too. For the consumer panel that we did, every single person there now had a refrigerator. They've all got a TV. That wasn't the case a few years ago, but now it is. How many of them had actually been away on vacation? One of them. It's basically white space. And we've seen in the West, particularly after COVID, that people want to go away. They want that experience rather than material things. And India is no different from any other country. China's done exactly the same thing. They're going to move into that. And so whether it's online travel, which plays the theme as well as the move to the digital economy, or whether it's hotels, whether that's luxury, basic, somewhere in the middle, these are all really strong multi-year structural growth stories that we think are incredibly exciting, and you don't really get exposure to them in any meaningful way, either with our peers or indeed with in ETFs or indices.
That something you said there made me curious, which is, do you find that Jupiter? we will definitely edit that bit out. Let me start that bit again. That's interesting you say that, because it actually spawns a thought in my head, which is, do you tend to find that India follows some trends to, say, other developing economies? I'm thinking the easiest facsimile, even though it certainly isn't a facsimile, is China. Does it tend to follow quite a few of the same trends in terms of certain sectors grow at certain periods, or do you find there's quite a lot of idiosyncrasies in what goes on there?
It's a mix. I think one of our advantages being a gem house based in the UK, but with 30 years experience of investing in India through myself, and our fund's been going for about 12 years now, is that you can take a step back and you can see the trends both from the West and from elsewhere in emerging and Asia, and apply them to India. Now, India always plows its own path. It will take bits from the West. It will take bits from Asia as well. And so the retail industry maybe will develop a little bit like Indonesia. The growth and the rapid growth of a massive country with a young and relatively poor population is exactly what China did 20, 30 years ago. And India is following that path. Obviously, digitalization and Silicon Valley type themes, India is very, very close to what's been going on in California. So it's taking a bit of that. For us, at Alquity, we want to focus on those long-term structural themes, which is incredibly important in a structurally growing and changing country like India. And if I may give you one example, when we launched this fund, there were no retail companies in the ETF or in the main indices. Now, that's clearly crazy, because retail is going to be a large part of the Indian economy, as it is everywhere in the world. So by identifying great companies that are going to benefit from these themes, you own them for that structural re-rating you get over time. An index tells you what has done well, not what will do well. And India is relatively unique in the fact it has this, we believe, decade plus of structural growth. And so we need to look what will be the shape of India 10 years from now, 5 years from now, rather than what was the shape of India 5 or 10 years ago.
There's an interesting point that you make there, which is something I've said for several episodes now, depending on the market. But I think India is a really outstanding point for that, which is analyst coverage of companies is sparse, and as a result, it's not an environment you want to be going passive ETF. It is very much where you want to be, choose an active manager, in my opinion. Don't get me wrong, obviously you guys pay for that, but the reason why you pay for that is the research that the teams do. But you tend to find over longer periods that, don't get me wrong, other parts of our multi-asset universe might struggle, on the active versus passive argument, but that's not typically something that I would say that a good EM manager struggles with particularly. So obviously I know, but for our viewers, you don't have a large cap bias. You tend to sit more mid and small cap. I know that you have a 7-factor kind of like framework to see that what supports small cap outperformance. Can you explain a little bit behind those factors and what's in place at the moment, and maybe, if they aren't ticking the box, what that missing piece might be?
Yeah, I think one of the things that I think makes us very different, and I think has been a strong contribution to our significant alpha generation over the 5, 10 and since inception, is that we have that multi-cap approach. So what I really try and do is find for our investors the best of India. Now, some of them will be large or mega caps. Some of them will be mid caps, and some of them will be small caps. And this is all in a daily dealing fund. I think that is absolutely the key to it going forward. Some of these companies are under researched, they're discovery stocks. And I think given the process that we have, it really is the way to generate alpha going forward. And if you look at our valuation metrics versus the large cap ETF or indeed the small cap ETF, you'll see that we tend to have faster growth, a higher ROE, and we tend to be cheaper. So I like to say that the best of India is an easy thing to say, but you actually can see it in the numbers as well. Now, small cap in India tends to outperform the majority of the time. It's not perhaps like developed markets where it's a bit of a niche. And the reason for India's stronger performance in that space is it's not a cyclical growth market. It's a structural growth market. And so small caps tend to be pro-growth. And therefore, when you have growth over 1, 2, 3, 5, 10 years, small caps generally outperform. And we have around half the portfolio is in small cap. It's a very entrepreneurial-driven country, and it's a very entrepreneurial-driven portfolio with first and second generation entrepreneurs. Now, what makes small cap outperform? There's a number of factors. Firstly, it's flows. We've talked earlier that domestic flows have been very strong, and until the recent last week in the Gulf, foreign flows had very clearly turned the corner and had become positive for the first time in some time. So that's a tick. Then we have accelerating GDP growth. We have lower interest rates. We have accelerating credit growth after a period of time. That's all coming through. The valuations are there. The earnings cycle, earnings revisions are coming through. We've seen broker upgrades at the individual market level from an underweight to an overweight. And so the missing piece has been performance. And small cap does well as long as large cap does well. You can't have large cap going down and small cap going up. Now, that's the last bit of the jigsaw. Now, again, that was beginning to happen until the last week. And they can be simultaneous. You don't need to have one, then the other. And so again, given that the sentiment has, in our view, fundamentally changed given the tariff deals, given that led to rupee strength, given we've seen foreign investors come back to the market, and notwithstanding the very, very recent past, that very much should and was looking like delivering positive returns, which is, in our view, the nirvana situation for small cap. Now, India is not a 1 year story; it's a 3-5 year story, and you have to have that time frame. But small cap consistently adds value over that medium term period.
So, not surprisingly, you've been broadly constructive through this conversation. What is the genuine bear case for you for India over the next, say, 12 to 18 months? And not for disclaimer kind of language, but what is the outlying events that you think, okay, if that occurs, then I might have a little bit of an issue?
Well, the timing of this is great because obviously we're living through one of them at the moment, which is the oil price. As we said earlier on, if the oil price was 120, 150 for 6, 9, 12 months, that certainly would be a bear case for India and indeed many other countries, but India wouldn't do well in that scenario. And I think if we were going to have that situation, we would have had it either in the very recent past or with the war in Ukraine previously to that as well. So that's number one, oil. We have to keep an eye on that. Secondly, I think it's politics. Now, this is a false concern, but it would be a market concern. Prime Minister Modi is incredibly popular. He keeps winning landslides at the state election level. He's relatively young for an Indian Prime Minister. He can keep going for some time. But if he were run over by the proverbial bus, then clearly that would be a short-term negative for the market. Would it derail the investment story? Well, actually, no, because I think having done this for so many years, the Indian growth story, as we talked about, is domestic and structurally driven. The difference now, over the last few years, is Modi has unlocked India's potential with that infrastructure that we talked about in the context of airports. You can't put that genie back in the bottle. You can't unbuild the airports. So there'd be a short-term concern. There are people in his party who would take over. And he's, in our view, unlocked that potential for India already. So after the near-term noise, the story would continue. Though it would clearly be a correction. So the two things that keep me awake at night, luckily I sleep pretty well, but oil and domestic politics would be the top of the list. Maybe you throw in some sort of geopolitics in there as well. India and China have a difficult history. They are on a warming path at the moment as well, but clearly something to keep an eye on. And India and Pakistan tend to have a flare up every few years. Now, we've just had one of those last year where there was a border war for a few days. The market didn't fall. Unfortunately, we've seen this a number of times before, and it was brought to a close fairly quickly. So as a subsidiary risk, I think geopolitics is something to keep an eye on. But oil, Mr. Modi would be the two that I would say you have to be concerned about.
I think that's an interesting point to look at it. The counter argument, so to speak, is that emerging markets tend to be politically a little bit, let's say, volatile. But we have had this stability now with Modi for quite some time now, and it does give that a little bit more confidence, I think, to a little bit more of a wider investor base. So obviously, this is a podcast episode that is meant for professional investors only. They're listening in. They've listened to this. What's their one takeaway you want them to take from this?
I think the one takeaway should be to consider whether in your growth equity part of your portfolios, India deserves a long-term structural allocation. Clearly, it's growth equity, but it moves to a very different beat to the UK, Europe, the US, or Japan. India's correlation with the S&P and NASDAQ is very low. And so given you have that structural story, which is different, given that you have the macro, given that you have the politics and the valuations, if India is something that you don't have exposure to, maybe now is the time to consider it. And certainly it's something to consider as a core part of the portfolio over the next 3, 5, and potentially longer. As a rule of thumb, if you go back 10, 20 years, people had an emerging allocation, they had an Asian allocation, and they may have had a China allocation as well. And I think India replaces that China allocation, but with a much better structural story. And I think you touched on something there about the politics. I mean, India's politics is remarkably stable. And although it's an emerging market, as we talked about, I think we have to perhaps question whether it's more or less stable than perhaps the UK, France, the US. Maybe the world has flipped on its head.
Seems bizarre now, doesn't it?
It seems bizarre even to say it, but there we go.
Thanks, Mike. So that's the end of my questions. So I really, really thank you for your time today, especially being our first external person to have on the podcast. So really appreciate that. Thank you very much.
Thank you for having me.
That's the end of today's episode. Do you have an exit disclaimer for today? So for today's episode, it was for professional audiences only, not for a retail audience. Any information within this is meant for informational purposes. It's not meant to be seen as promotion, but also that any past performance is not an indicator of future performance. Also, for full disclosure, Cape Berkshire is purchasing a allocation within Alquity India Focus. We have done in the past, we have sold it, we are going back in, but that is not related to today's podcast. We thank you very much, and we'll catch you in the next episode.